So I will go ahead and turn it over to you, Eric. I'll let you introduce yourself and tell everybody a little bit about what we're going to be discussing and who you are.
Great. Well, thanks so much, Melissa. I really appreciate the opportunity. And thanks for everybody for joining the webinar. I'm excited to talk to you about what I'm seeing out there in the capital markets and just exchange ideas, get some questions. I don't really have a formal structure where I just kind of give a stale presentation. I really like to have some dialogue and really talk about what questions you have. But what I have done is kind of put together some common questions that I get on a regular basis from clients who are investing in multifamily real estate. So I do look forward to hearing your questions that Melissa's going to share with us and addressing those. But first, I'll tell you who I am and what I'm doing up here. My name's Eric Stewart, and my company is Atlantic Business Capital. We are a commercial mortgage brokerage firm. I also own multifamily properties throughout the country, from out in Phoenix all the way to Atlanta. I've got partners in each one of my deals. As with many of you, we kind of form these partnerships and everybody brings value to the table. Some of my deals that I've invested in are just our clients that I've actually closed loans for and just put my fee back into the deal to show faith in the client, and also, because I believe in the deal. And then other deals are ones that I've spearheaded myself, through broker relationships and sourced. So it's really, it really runs both ends of the spectrum. And I would love the opportunity to answer any questions and help you folks, bridge these gaps and get over these barriers of entry that you a lot of times see in the market. And that's the foundation for what I was hoping to talk to everybody about today was, to put together some topics about how you can quickly look at a deal and understand what type of financing is available and where you're going to go, because there are some specific questions that you would ask yourself about the deal or characteristics you would look for in the deal, to know, is this an agency deal? Are we going to have to go conduit with it? Is this going to be a recourse deal or not? What type of amortization can I get? All these different questions that you need to underwrite your deal and know what terms to put in. A lot of times you can just quickly look at the asset and look at the offering memorandum and know right away if it's going to qualify or not. So I was going to touch on some of those. Another question I get a lot of times is in the purchase and sale agreement, the PSA, and timelines on those, and how your specific loan is going to impact those timelines. We never close fast enough when we're on the selling side. So if you tell them it's a 30-day close, it's going to have to be a 20-day close, and that's understandable. But I'd like to kind of go into how that PSA is scaled, because it's not always about how quickly you can get to the table. A lot of times it's more, the seller's more interested in how committed you are to that acquisition. And there's one way to demonstrate commitment to a deal, and that's spending money. In a seller's eyes, they want to know how much money you've spent on this deal and how much you're going to lose if it doesn't close. To them, that's commitment. And if you were selling a property, I think you'd probably feel the same way. So I'd like to talk a little bit about that. I get a lot of questions about non-recourse loans and where that space is, who's putting the money out, and what it really means. So I want to do just an overview on non-recourse and when you can expect it, and then sponsorship. A lot of times to get into this industry as a multifamily investor, your most attractive debt requires some level of experience. It requires some minimum financial strength and fiscal responsibility. And a lot of folks may or may not have that and will partner with others that do. And so I want to just briefly talk a little bit about that sponsor and what a lender considers a sponsor, what an investor would consider a sponsor. And then throughout this, I want to address questions that you have. I know Melissa's going to jump in and talk about some areas as well. So let's get started. When you're looking at your line, look at some finer points. You can very generic characteristics of what you're looking at that are going to define who you're going to go to for a loan. So things like your property type. Is it a multifamily property? Maybe you're looking at some other type of commercial asset, like a self-storage, retail, office, something like that. Multifamily is going to have a specific set of lenders, as would any other type of commercial real estate. So understanding your property type is key. Also, whether it's 1 to 4 units or 5 plus, that's going to have a huge impact on where you're going to go for your loan. The size of the loan is very important. So $1 million, a $1 million loan amount is a benchmark in the industry. That is a definitive characteristic of where you're going to go for the loan, what your loan terms are going to be, and whether or not it's going to be a recourse loan or a non-recourse loan. Now, it's not necessarily the same lender taking away the non-recourse aspect if it's below $1 million, but it's who the lenders are in that space. So loan size is very important. Another one is occupancy. The occupancy, the asset, and the seasoning of that occupancy is going to tell you very, very quickly where you can go for that loan, who's going to fund that deal. And also it's going to relate to what type of value add you've got available. And the location, the size of the market that you're buying in is really going to impact your lender bucket. And if you're in a tertiary market, small market, maybe it has limited economic drivers, your lender bucket is going to be equally as limited. Your loan terms it's going to be reflected in your loan terms. So those are some of the areas that I'd like to connect on today. If it sparks some questions, please feel free to jump in and we can connect on those. But yeah, let's jump right in. As far as property types go, the first thing you're going to look at is whether or not it's an owner-occupied or investment deal. Now, we are in a world of investment properties. The reason I put this up here is because there's a certain set of lenders that may or may not do investment deals. And let's say you're talking to a depository lender, a credit union, or some type of FDIC bank, FDIC insured bank, it's very important that you vet out right away whether or not that bank will lend on investment properties and multifamily. Because if they're a portfolio lender, a lot of their appetite is predicated on what their current portfolio has and what they're currently leveraged in right now. So you may talk to a bank and they say, we're full on multifamily right now. We're not doing any kind of multifamily. We're not doing any type of investment properties. We're really looking for owner-occupied properties with SBA guarantees or something like that. Could be the opposite. Could be, they might be waiving in multifamily. But the important thing to do is to get to the commercial loan officer as quickly as possible. Branch managers are great for the introductions, but they have more of an overall focus on that branch's operation. They're going to answer questions on Friday afternoon from their boss, their regional, about money in and money out. So there's most likely going to be a specific division that handles commercial properties. That's the person you want to get to. So, if it's a multifamily property, you're going to have access to a certain set of lenders, agency lenders, particularly Fannie Mae and Freddie Mac, in addition to conduit lenders and depository lenders that have an appetite for that. If it's a commercial space, office, retail, industrial, it's a little bit more limited because you're not going to go agency with it. You're not going to go Fannie Mae or Freddie Mac. You'll still go the CMBS route and your depository lenders, but agency lenders are really just looking at multifamily. And then your special use properties. Those are your car washes, your gas stations, things of that nature, which obviously are not going to go agency, and they're going to have their own specific set of loan parameters. So property type is going to tell you very, very quickly who's going to do that loan. Now, loan size is another different. The $1 million loan amount is a definitive benchmark in the industry. Again, not because a lender is going to change their programs, but it's primarily a function of Fannie Mae and Freddie Mac's small balance loan program. That program will do loans from 1 million to 6 million nationally. And in some major markets, they'll bump that up to say 7.5. And in some cases, even higher. They're pushing to do that now. But that $1 million floor is as solid now as it ever was. We're actually seeing a structure now where Freddie Mac's small balance program is 1.2 million minimum, but they make exceptions down to $1 million. So that floor is more firm now than it has been in the past. So when you see a deal, and let's say you're competing in a space of say 30 units to 50 units, 20 units to 50 units. You're competing in that space because you find that you're just more competitive. Maybe there's more product in your market. You really want to focus on acquisition price, purchase price in that 1.3 to 1.5 and up. If in a perfect storm, 80% leverage is industry standard in a perfect world. So if you're buying a property, you negotiate down to 1.25 million, at 80%, you're really hitting that $1 million mark. So keep that in mind on your purchase price and your loan amounts. If your loan request is below $1 million, that's going to shift to a different lender bucket. It's either going to be depository lenders, or it's going to be some of my alternative lenders that are very competitive. They offer solid terms. They might be priced a little bit higher than your banks, but there's a lot of value in those as well. So we've got options in the sub $1 million loan space, but it's not going to be agency. It's not going to be your Freddie Mac deal. It's not going to be your Fannie Mae small balance deal. Another characteristic of that sub $1 million world is that it's most likely going to require a personal guarantee. Now, if you end up at a bank, they are going to look at a couple years tax returns. They're going to do a deep dive into what they call your global DTI, or your global debt to income. Again, they are going to look for a personal guarantee from you. You'll probably see shorter amortizations. 20 to 25 years is very common with those depository lenders. In the small balance world, the 1 to 6 million, that's high volume, and right now they're doing all the business they can do. They're seeing a huge volume right now. And then north of 6 million is really dominated by, Fannie and Freddie as well. Also your CMBS, your commercial mortgage-backed securities, your conduit world, your insurance companies. There's a lot of lenders out there in that 6 million plus space. And as you get up into the 10, $15 million, it widens up even more. So loan size really has a lot to do with characteristics. Now, in the commercial space, if you're buying a retail property, you're buying a office or an industrial property, once you get below a couple $1 million, your lender bucket your non-recourse lender bucket anyway, is very, very limited. So you're looking at depository lenders, again, your banks, your credit unions, and typical banks. And then we've got some alternatives to those banks that can be a really solid source. If you're north of 2 million, again, that's where you have your conduit lenders, your life insurance companies. Those are your non-recourse lenders for your investment companies and folks that really want to look at the asset itself to service that debt rather than putting a personal guarantee on it. A characteristic that you want to look at, and it's a quick test to know where you're going to go with this asset, is your occupancy. So multifamily space, stabilized multifamily debt is 85 to 90% physical occupancy, depending on the loan size. And that's why I put that range in there, because if you're in the small balance space, that $1 to $6 million space that we talked about earlier, that's when you're going to want to see 90% physical occupancy. Very quickly, you're looking at a property and it's a multifamily asset, and it's a $2 million loan amount. You're planning on going Freddie Mac and using their small balance loan program, but the physical occupancy is 87%, or you don't have 90% physical occupancy for the 90-day requirement. You automatically know you're going to have a tough time getting that done with Freddie, right? So we may have to switch to a depository lender. We may have to season the property, or look into what that is, or just maybe do a bridge loan, depending on what your plan is there for value add creation. The commercial space, your industry standard is 80% occupancy. However, they're a little bit more lenient with that. It's not quite as hard and fast. If we're running in the high 70s, but there's a story behind it, it's cash flowing strong, we can oftentimes get those done. And then the special use properties is very deal specific. There's not really a standard on the occupancy side, because oftentimes there's just one tenant in there. So those are a little bit about the occupancy requirements. That can be a really quick test for you. And then market size. It's if you're in a smaller market, a lighter population, limited economic drivers. By that I mean there could be a major employer, but if there's only one major employer, your lender sees that as additional risk. As equity investors, we look at the source of that employment. We understand what base realignment means to a military market. A lender is going to see a limited economic driver, whether it's, and they'll dial back their terms. So whether it's an oil and gas market, whether it's a military market, not necessarily, even at your property, even if your property does not have a high military concentration, if the market itself is driven by a military base, then it's going to be considered a military market, and you'll feel those effects in your leverage. So really important to know who the employers are in your area. The more diverse employment base you can provide to a lender, typically the better terms you're going to see. Major markets, it's 75 to 80%. And I say 75 because even in markets like Houston, we might see 75% leverage there. Fannie Mae actually, starts their bidding at 65, and we have to make exceptions up from there. But in most major markets, you're looking at 80% leverage on your multifamily deals, 65 to 75 on commercial and special use properties. Getting above 65% is going to require a story. In your smaller markets, that's when I would ask you to not dial in anything more than 75%. Now, we can get 80% on multifamily deals in a lot of these smaller markets. Fannie will do it, and most of the time Freddie's going to cut back to 75% in small and very small markets. In that scenario, that's when we would look to Fannie Mae and leverage their program. Because a lot of times they'll do 80% in those markets. You're just going to cut back on some of your other characteristics, like you may not see the 3 years or 2 years of interest-only payments that Freddie Mac's small balance program will offer, and it might get priced up. So just keep that in mind. I would like to see, for your analysis and your quick snapshot, which is what we're talking about today, I'd like to see you dial in 75% leverage in smaller markets. If we can get 80, great, but it's better to, in my opinion, it's better to not underwrite to best case scenario and then potentially have to lessen the attractiveness of your deal, aside from, or instead of underwriting to conservative terms, not crippling terms. We don't want to kill a deal, but underwrite to conservative terms and then better those as you go through the process. Commercial deals, 65 to 70% in small markets is common. And then again, special use is going to be case by case. I can't stress enough the economic drivers of your area. It's, and I talk about this with my partners and my clients a lot. It's not always about, what tenants are paying you. It has a lot to do with who's paying your tenants. So keep that in mind, where those jobs are. Another characteristic, or another item that I wanted to talk about, and I get a lot of questions about this, is PSA timelines, purchase and sale agreement timelines, what to dial in on your purchase and sale contract so that you're not stressed, so that you don't have to keep asking for extensions or get hit with unrealistic extension fees, which can happen a lot of times. So I talked about this earlier. One of the things that I see with my sellers and also, or when I say my sellers, I mean property that I'm buying and also working with clients, is that it's not always about how quickly we can close, which is very easy to default to, but more about how committed you are as a buyer to buying that property and actually going through with the closing. By that I mean, and in a seller's eyes, your commitment is defined by what you have to lose if the deal doesn't close. So it comes down to that earnest money deposit, how quickly it's going to go non-refundable, how quickly you are ordering your third parties and making application with your lender, and from that point, how quickly you can get to the table. Because once you've done that, then they just want to close. So that's why I put in there, it's a monetary commitment versus a fast closing. It's not always about how quickly you can get to the table, but how committed you are to get the deal. I've lost deals before to other investors that I was competing with that just frankly were willing to put more money up at closing. You know, I mean, $300,000-$400,000 hard on a contract in 5 days or even on the effective date. You may or may not be willing to do something like that. So in that scenario, you end up bowing out, letting somebody else name that tune. So keep that in mind. It's about scaled exposure, and you very well may be able to win a deal and stay competitive, even though you may take 75 days to close a deal. If you're committed to that closing, that seller may be open to working with you. So let's talk a little bit about lender timelines. When you are structuring your purchase contract, you're going to want to get your due diligence items from the seller as quickly as possible. So I have a lot of clients that will structure the effective date of the contract when they receive all their due diligence items listed in there. Or, you know, they'll put a requirement in there to have them within 3 to 5 days at a minimum. So that's one way to really help speed things up. Another one is to, even though you may put a 30-day inspection period on there, you internally as a buyer really want to focus on knocking that out within a 20-day timeline, which allows you to engage a lender quicker. Again, that lender engagement is going to require a monetary exposure on your side. It's going to require that you spend money. You're going to send in an expense deposit anywhere from, could be $7,000, it could be $50,000, depending on some bridge deals that we do. It could be 70. So it really depends on the specific lender as far as your good faith deposit. But from a seller standpoint, they see you spending money, because when you send that money in for your third parties, it's going to be spent right away. It's going to be used for an appraisal, for an environmental report, for a property condition assessment, and then there's going to be a legal retainer in there as well. So you want to show the seller as best you can your monetary commitment to the deal. Now, once your due diligence period is up, you may or may not be hard with your earnest money, or that earnest money may be non-refundable. Oftentimes it's not, but that scaled exposure comes into play to where you've told the seller you can't pull out of the deal, or you won't pull out of the deal for property condition, right? So you've taken that exit door away, and you still may have your finance contingency in place. Finance contingency, oftentimes that may last 2 weeks past the due diligence period, it may last 30 days past the due diligence period. It might not exist at all, but those are some of the nuances that you can play with inside that contract to really help make it more attractive to the seller, help you earn the deal, but also not have your earnest money non-refundable from day one, and help protect you. So your lenders are going to need, in general, industry standard is 60 days. And that's just a very generic number. You know, your Freddie Mac lenders they're going to high five each other if they get a deal done in 50 days. And a lot of that comes down to how we can expedite the reports. You know, your appraisal is up to how quickly they can schedule. Your environmental and your engineering reports, again, they've got to get on site and prepare the report. So sometimes that can be the driver on the timelines. But in most cases, it's going to take a couple months to get an agency deal done. A lot of your conduit lenders, your CMBS lenders can get that done in 45 days. And if you order expedited reports, your agency lenders can do that as well. A bridge loan is a standard bridge loan is about a 30-day close. And that's for a reasonably priced loan. If you go to a lender that adds additional value, let's say a hard money lender that adds additional value to get to the table quicker, obviously you're going to pay for it, and you want to make sure the value is there. So in your bridge space, if you're going in with 1 to 1.5 points to the lender up front and mid-single digits, 4 to say 6%, 7% interest, that would be a typical 30-day close. I've got some lenders that can do it sooner at reasonable prices, but inside of 3 weeks is going to be pretty tight. If you are working with a lender that's charging a little bit more, a couple points going in, maybe 8 to 10% coupon, those lenders can typically get to the table much quicker. You're talking maybe 10 days or something like that. And a lot of what they'll do is get on site themselves and do their own valuation rather than hire a third party to do that. So you pay for that value, but if you're seeing that in your purchase price, and the value is there to the seller to close quick, maybe you take you take that additional expense on. So just some things to consider there when you're dialing. And as we talked about, there's a due diligence period deadline or inspection period deadline where you limit your reasons for getting out of the contract. That's why I use the term scaled exposure. There's also oftentimes a deadline for when you will make application to the lender, and I put a dollar sign there because these are areas where you're spending money that you're not going to get back. Your finance contingency's up. That's another scaled exposure where it's just a reason you wouldn't pull out. And then your extensions. It's wise to have an extension dialed in into your original purchase contract. But if you go beyond that and you have to go back to the seller for another extension, which is very common, it's also very common for them to decide what that number is, and that can get rather costly. So it's important to note that it's not spending additional money. It's not money that's going to be added to the purchase price. It's almost always goes towards the purchase price, but it is an additional commitment to you that you would lose if you didn't close. So remember, it's not always about how fast you can close. It's about your scaled exposure of your earnest money that can win that contract. So that's the nuances that I see. And, any questions you guys have, please feel free to jump in the chat room. I can't see the chat room on the screen. So I'm going to look to Melissa to jump in and let me know if there's any questions.
Yeah, there's a couple of questions in the chat box. I didn't know if you wanted to wait till the end or go ahead and answer those now.
Well, if they're pertinent to what we're talking about, I'll jump in.
Okay.
And then that way we can kind of stay on track before I move over.
Let's go ahead and answer these questions. So Katrina asked, we are looking at the underwriting for a design build 31 unit project with no construction loan. The GPs own the land. When we do the raise from the LPs, how easy will it be for the GPs to get a backup LOC for this project?
It's predicated on a lot of different things. How the ease of getting that is your banking relationships. That type of debt structure is going to be more of a local depository lender that wants to be involved in that project. It also depends on the financial strength of your GPs, the financial strength of your contractors, and what that overall deal looks like. You're going to have to present your feasibility studies and all the financials to see it. It can be tough. It can be tough if the demand's not there. Depending on what the permits look like going forward, it can be challenging. That said, if the financial strength is there and the banking relationships are already in place, then you should be able to get that done. There's a lot of variables involved, but those are going to be what you focus on: is the financial strength of the GPs and the strength of your contractors.
Great. The next question is from Kenneth. My net worth is tied up in an irrevocable trust. What are the possibilities to guarantee loans as a trustee? The trust documents allow the trustees to use assets as collateral.
It's a great question, because I've got some great friends who focus on asset protection in the industry. It's a really big industry, and it runs parallel to what we do. The trust, when you've got your assets in a trust, the trust is its own entity. So you'll find that a lender obviously is going to want to see all the trust docs, and the trust itself will have to sign on as a principal entity for the transaction. So as long as you do that, they can recognize those assets, both liquidity and the net worth. So we can get that done. We just have to bring that trust on as a principal entity.
Okay, and this next question is from James. What percentage earnest money are you seeing for strong commitments?
Great question. And the put a quarter in, get an answer out is 1%. But that doesn't always work. It's what I do, and what I recommend is to talk with your broker and try and get an idea for that seller of what you're competing with. I can tell you that I lost a deal, and I made reference to it earlier. I lost a deal where it was if I remember correctly, it was roughly about a $4 million purchase. And I was going to put up a roughly 100 to 150 in earnest money. And I lost the deal to a shop that came in and put about 250 to 300 down hard. So, I'll start with the 1% and then see what kind of temperature and what kind of response you get back. It's never going to be enough, right? If whatever you say, it's always going to be, you need to do a little bit more, and it's going to have to go hard a little bit sooner. That's what we always see. So you've got to work with your broker on that relationship. But starting at the 1% mark, there's nothing wrong with that, and then working your way up or down from there.
Okay, great. That looks like all the questions right now in the chat box, but I encourage everyone to jump in and ask questions as we go through. I'll let you continue talking now.
Okay, great. Sounds good. Second, I get a lot of questions is the non-recourse aspect of these deals, and the rest of the presentation that I wrote here. It really focuses on questions surrounding that non-recourse debt, in how that correlates with a sponsor, forming partnerships, and then what lenders really look for, and what that really means to you. So, primarily we see non-recourse debt on investment properties. Obviously owner-occupied properties, you're going to have that personal guarantee. Your securitized lenders that are selling your loan and pooling your loan with other debt as an investment, that's where you're going to see the non-recourse aspect come into play. Most of your portfolio lenders are not non-recourse. They want to see a personal guarantee at a certain leverage. Once you get below, say, 55%, there is a possibility that they would negotiate that, say 55% leverage, some 50. But above that, they're going to want to see some type of personal guarantee. And I get a lot of questions about why they need to see this information. Why do they ask for financials, resumes, and whatnot, if they're only looking for the property itself to service the debt? And I want to talk a little bit more about that, because it doesn't lessen they're not looking to lessen the quality of their underwrite or quality of the overall investment, they still need to confirm that they've got quality individuals, or warm bodies as they're referred to, running the operation. And they've also, that's why they see these specific documents, financial statements, schedules of real estate, and resumes. So they don't want to lessen the quality of the investment by making it non-recourse and not requiring a personal guarantee. They just structure it so that it's more feasible for that. So when you're buying investment properties, as we do, it's primarily about who they're looking at to service the debt. So yes, we all like the fact that they're not going to come after us personally and take our homes, as long as we don't trigger a carve out or a bad boy clause, as they're called. We like the fact that it doesn't necessarily show up on our personal credit report like our home mortgage does, and that type of thing. But it's not as though it's 100% on the property and that we don't even exist, right? There are specific characteristics that we're going to have to prove and qualify for. They just don't look for our personal income to service the debt. That's going to be the primary driver of this non-recourse component. Now, once you get below $1 million loan amount, it's challenging to find anybody to do that non-recourse debt. Now, if you're strictly bringing in equity from an IRA, then there are lenders out there that will do that. They'll do all loan sizes, but 100% of the equity has to come from an IRA in order to find that money. Otherwise, you're most likely going to be working with a lender that requires a personal guarantee. If it's a commercial deal, it's probably a couple $1 million. Most of those lenders don't like to go below a couple million. But on multifamily, we can go down to $1 million. Here's what they look for. They look for a personal guarantee from you. Oh, Melissa, was there a question?
Yeah, there's a question if you want to pause and take this one.
Sure.
I'll read it to you. Dan asked, can you highlight products available for new construction where obviously there is not occupancy until after stabilization? Would construction loan until occupancy requirement be the way to go?
Yes. To the second question, I mean, clearly that's you're going to want to stabilize the asset rather than do some type of interim financing. Obviously, it'll depend on what that first debt structure looks like in your timelines and your completion timelines. But in most cases, there's going to be a period of time where that your lender will allow you to stabilize the asset before you would refinance. The construction market with my client base, which I don't do a whole lot of construction. Most of what I do are existing stabilized assets or renovation deals. We don't come out of the ground with a lot of stuff. That space is primarily on the smaller levels, below 20 million or 25 million. It's dominated by your depository lenders locally. Recourse guarantees, as we're talking about here, are almost always required, and it really requires a strong financial partnership and strong GC partnership. But to find the debt, that's when you would talk to a local depository lender in the area. Those are the ones that are going to offer you the most flexibility and really want to dive in to see that area grow. So that's my recommendation there. And as far as that construction loan, there should be a component that will take you through stabilization and then give you an opportunity to refinance out into your permanent debt.
Okay. There's no other questions right now, so you can keep on.
Okay. Sounds good. Getting back to the non-recourse aspect, they're for some core information from you. Most of your lenders are not going to look for tax returns, and if they do, they're not going to underwrite to the income from those tax returns. But they do look for a personal financial statement, right? Assets on one side, liabilities on the other. They want to determine your net worth and what it's made of. A schedule of real estate owned. And I can send you templates. You can go to the website, atlanticbusinesscapital.com. And I can send you specific templates for the various loan programs and lenders that we go to. But that schedule of real estate owned is an important document because that's going to detail the health of your portfolio, right? It's going to document the NOI. It's going to document what cap rate you're assessing to those properties, what type of leverage is on there, what type of maturity risk or refinance risk that you're coming up with. And lenders look at those. You know, if they see a property that's sub 1.2 debt service, they're going to ask us about it. If you've got maturities coming up, they're going to ask what the plan is there. So it's real important to keep your schedule of real estate current and understand what's on there and be able to talk about it. Your commercial real estate resume, it's more of a portfolio overview. Obviously, we've all got transferable skills from other industries that we leverage for our success in our real estate investing. Focusing on those is fine, but really drilling down to your commercial real estate experience or that of your partners and your team is what's gonna fare the best on that resume. I get the question a lot, you know, why are they asking for this information if it's a non-recourse guarantee? If I'm not guaranteeing this personally, what do they need this from me for? Well, your lender doesn't get rid of the recourse guarantee to lessen the quality of their investment or lessen the quality of the investment that they're offering to their debt investors or their investors. You know, they need to maintain a solid understanding of who's running the property, what type of experience level, what type of third party management level is in place. And to do that, they need to see that the financial strength, the fiscal responsibility, and the property level experience as well, the like property experience. All that lends itself to the success of the deal. So they put those in place, those net worth requirements in place, those post-closing liquidity requirements in place, and experience requirements in place to maintain the quality of their investment. Now, the post-closing liquidity is something that we'd really want to talk about because it's interesting. If you're doing a refinance, it's pre-closing. So one of the characteristics that you're going to see in a common theme with lenders is they don't necessarily want to make the borrower, so to speak. They don't want their proceeds that they bring to the table out of the equity that may be created for that investment to be the qualifying liquidity. They want to see that it's there prior to the close and it's not an event that they did to create that liquidity. Why they would see that, whether they want to see that liquidity at all, is again to know that their borrowing team has the ability to crutch that deal along. If there's an insurance delay, let's say you have a fire or a flood or something like that, and you've got to make that mortgage payment while your income is down, the operations are crippled. They want to know that their borrowing team can do that. They want to know that there's some cash there to mobilize those contractors and get them going. And they'll certainly reimburse you, and they know that money is going to be reimbursed, but they want to know that there's somebody there that can keep that operation going, keep that loan current. And to do that, they look for liquidity. Now, a common liquidity requirement and an industry standard would be 10% of the requested loan amount. I know there's a lot of people that are scratching their heads because you've heard six months of debt service. You've heard 9 months of debt service in 12 months. Yes, you are correct. Depending on the loan program, it can be as low as 6 months worth of mortgage payments. Most of your small balance lenders, $1 to $6 million, you're looking at about 9 to 12 months worth of debt service is what they want to see. Industry standard, what will keep you safe, whether you're working with a private client group for, an equity firm, whether you're going to, a small balance lender, 10% of the requested loan amount is standard. That's why I say the 10% number. Another characteristic here is they also like to see that their key principals are putting money in the deal as well. They want to see that they're not the only ones that are putting money in. Even though you're signing on the loan, it's a non-recourse guarantee, they'd like to see that you've got, and you as a key principal, anywhere from 5 to 10% of that equity injection out of your money coming into the deal. So keep that in mind. That's a characteristic that it's sometimes counterintuitive with us as syndicators because we like to keep our liquidity available. But a lender does like to see that you're putting some of your own money in the deal, as do your investors. That's a common question that a lot of my syndicator clients get is, how much of your own money are you putting in the deal? And there's a balance there. So just keep that in mind. That's when you talk about, when you ask the questions of why they need to see your information, that's just some philosophy behind it. So, hey, Melissa.
Hey, so Katrina asked, she said, I went out to your website. It looks like the various downloadable forms are missing. How do we get these forms?
I will fix that. It could be some type of compatibility with your browser, but I will immediately find out what that situation is, get it fixed, and I'll make sure that you have my email as well. If for some reason you have any trouble at all, please reach out to me. I would consider that a favor, and I would appreciate it if you'd reach out to me, because I've got to make sure that we stay connected and I make it easy for you to contact me. So thank you for letting me know. I will address it right away. And, please feel free to email me as well, because my contact information will be there. So thanks.
All right, that looks like all we have right here.
Okay.
Continue.
Yeah, and along the same lines, I know that we're getting close to time here, but talking about sponsorship is something that I'd like to just give a little bit of insight to, because as an investor, I work with, and I pride myself on this. I've built a career over, the last 20 years in commercial real estate. Ever since say 2007, 2008, I focus on investors that are coming into the multifamily space, coming into the commercial space, looking to get started and build their career. I've really found a wonderful space there, and I really enjoy working with folks that are coming into the space. I found I seem to offer more value there than working with an institutional firm that's doing $100 million transactions. I really enjoy getting on the phone and talking through these procedures with you, and I have I take a lot of pride in my clients that have gone on to to teach others. They've become educators, and they brought people underneath them to work as well. And so it's really a great process to be able to give back. So a lot of times getting into this business, people to qualify for the loan, a syndicator, you might be able to raise money. As a syndicator, you might be able to source the deals and find the product, but without that experience and without that financial strength, it can be challenging to qualify for a loan. Well, that is when you would say you need a sponsor to qualify for a loan. And I think it's important to note that a sponsor isn't just somebody that gets the loan approved. A sponsor for you as a syndicator is a partner in your deal, someone that's coming in to enhance the certainty of success of that operation, leverage their experience, leverage their financial wherewithal, leverage their relationships in the industry, whether it's somebody to negotiate your taxes, somebody to do a cost seg study, other investors maybe. This individual that you're calling a sponsor is a partner, and the reason that a lender wants to see that individual in that deal is really the same reason you do. It's to enhance the certainty of success for that asset, and round out that team. It doesn't just mean that somebody's signing on a loan and going away. Lender doesn't expect that, and I don't think you do either. So it's really a partner that you're bringing in to help make that team strong. And with that, because we use corporations, we buy these properties in LLCs. When a lender looks at the sponsor, they consider it anybody who's signing on a loan. So you might be getting into the industry and bring a partner in, and they're going to sign on the loan. I highly recommend that you do as well and begin that lender relationship, because they're going to look at you as a sponsor as well. They're going to look at anyone who signs on their loan and signs as a sponsor. So for you starting that relationship, it really has a lot of benefit long term. The financial requirements, the experience requirements, they're cumulative. So, if one person happens to be bringing a lot of experience, but together your financial strength is where it needs to be to get the loan done, they look at all of the key principles together. And those key principles are triggered or qualified by individuals that have a management component. So they have management control, they're managing members, or in most cases, they own over 20, excuse me, they own over 25% of the asset itself. There's certain programs that will allow up to 50% ownership before they consider that individual a key principal. But in general, you want to keep a note on the side of your desk that anybody that owns 25% or more of the asset itself will most likely be required, at least be underwritten, probably be required to sign on the loan, but at a minimum, that lender's going to want to do an OFAC search and a credit search on that individual. So just keep that in mind. That was really the core of what I wanted to talk about today. I'm excited to be able to talk to you guys in the future and sit back and chat with Dan a little bit and just kind of have a roundtable with him on do deeper dives on what he's seeing and what we can talk through. But for today, I really appreciate you letting me bend your ear for a bit. Melissa, I'll see if you have any other questions, and then I'll give my contact info.
Yeah, I don't see any other questions in the chat box. James said, as always, good information. Eric, thank you. I'm going to go ahead and put your email into the chat box just so people can copy and paste that.
Okay, great.
So make sure you grab Eric's email if you have questions after the fact, but we have a couple more minutes if anybody wants to revisit a topic or ask any other questions. We'll wait a minute or so and see if anything else comes in.
Sure. And I can tell you that just some current market information that we're seeing, there was a lot of talk at the end of last year about Fannie Mae and Freddie Mac and what type of monies they were going to have going forward. And, in the third quarter of last year, things really tightened up substantially. Now, they were still lending. There's folks out there that say they shut down and they weren't lending anything. Fannie and Freddie were still lending in third quarter of last year, in the fourth quarter of last year, but once they got their allocations again, and they were given the direction on that, things certainly opened up. Now, what we are seeing right now, and I think this is important to note, is it is a little bit choosier credit environment. They're not making exceptions like they were on smaller deals. Right now, the agencies seem to have more of an appetite for affordable deals and more what they call mission-driven properties, which is, essentially what they're there for as well. They're not meant to be the lender of choice. But as it stands now, they are giving incentives for more affordable deals. And they've sort of pulled back on a lot of the discounts they were giving for your green programs and your environmental programs. We were seeing a lot prior to the third quarter. We were doing a lot of deals, and we would call them green deals, and you'd see about a 30 basis point discount in your interest rate for that. That went away, but the affordability discounts are still there. So keep that in mind.
Kenneth asked, where were the documents located on the website again?
Oh, they should be on the tab, on one of the tabs at top that's on the drop downs. If it's not there, then please shoot me an email, and I'm one, going to address the website if it is a glitch, and two, I'll make sure to get you those documents right away.
Yeah, everyone make sure you get Eric's email just in case that there's any issue with accessing those forms. That helps. Okay, does anybody have anything else? We have just a few more minutes. Chris asked, can you expand a bit more on the affordability housing area for Fannie and Freddie?
Yeah, it's actually rather market specific and deal specific. So it's challenging to go in and go through the specifics on that just in general terms. But when you have a property that you're looking at that we can go through and look at the rent roll and define how affordable those properties are, meaning what percentage of that median income is going to be able to afford those rents. You're assigned you're given a certain percentage of affordability, and with that, you're going to see specific discounts on your interest rate. So without having the property in the specific market to go into, it can be challenging. But I will say that the affordability components are important to your agency lenders right now, and we can see some pretty healthy discounts based on how that qualifies.
Great, thanks. Okay, well, I don't see any other questions coming through. Thank you so much, Eric, for your time. That was very informative. I know I will be sending out the replay of this to our network so everyone has access to it. And if there are no other questions, we can go ahead and wrap it up.
Well, thanks so much, Melissa. I really appreciate you having me, and I look forward to catching up with everybody. Thanks so much.
All right, thank you.
All right.